Nobody can predict the future, of course, but it seems likely that the days of consistent high double-digit returns, a la the 80s and the 90s, are probably long gone for a while. So a perplexing problem comes to mind: how to invest in a low return environment. Your financial needs surely haven't gone down with the returns of the market. Probably, I would venture to say that your financial needs have increased over the past decade. Now, growing complacent on the heels of generous stock returns, some fundamental principles of sound investing seem to be thrown out with the trash. After all, when everything is going up, long-held principles such as diversification, controlling cost, and some other issues seem to be outdated. Okay, so now that those happy days are gone, we've got to get back to the basics of investing. Fortunately, you can still eke out a decent return by following some very, very basic principles. Number one is to save more. We've heard this over and over and over during the last few months, or maybe over the last year. Hopefully Americans have learned a dangerous lesson over the past few decades that has been coming crashing down in the last few months. The idea that you can retire comfortably with saving as little as 4, 5, or even 6% of your income by relying on the market to give you the generous returns, that idea is dead, at least for now. Investors can no longer count on the market bailing them out for poor decisions and miscalculations. If you want to retire comfortably, you're simply going to have to save more money. As a general rule, you need to save between 10 to 15% of your income, and that's at a minimum. That's a simple rule of thumb. If the market somehow managed to churn out double-digit returns in the future, well, good for you. That means that more money in your pocket. But don't depend on it. There's a very good reason most how to invest articles list you have to save more money. Do it younger, do it faster, and at the end you end up with more. Number two is that costs do really matter. A la the Fidelities, the Oppenheimers, and so many actively managed funds, and so actually many mutual funds, at an expense ratio of 3, 4, 5, 6%, and even higher sometimes, isn't too bothersome when the stock market is returning 12%. It's an entirely different story when the market gets back to the usual average of 7 to 8%. Why would you give up your return to a mutual fund manager who can't even beat the market when there are plenty of low-cost alternatives costing half or even less of what you're paying now? Since very few funds are able to outperform the market over the long term, the wisest course of action is simply to buy the entire market and diversify globally as cheaply as possible. Number three is always most important. Let's minimize our taxes. Nobody likes paying taxes. Nobody. Especially when profits are down. Fortunately, there are plenty of ways to minimize your tax liability and keep your returns to yourself. You're using tax-managed mutual funds, index funds, municipal bonds, and other tax-efficient investment instead of using the actively managed funds, taxable bonds, or real estate, especially avoided outside of tax advantage retirement accounts. As you might have guessed, how you arrange your portfolio based on tax implications of various asset classes has an impact on your account balance over the long term. Number four, folks, we always got to stay diversified. If you can't maximize your returns, we can at least minimize the risk. Making risky investments in an attempt to gain above average returns is a recipe for disaster, and it's been shown over and over again. At the very least, you should own at least three basic asset classes if you have a small account and you're just getting started, and those are domestic stocks, foreign stocks, and domestic bonds. High quality government bonds. Diversification won't earn you huge returns, but it will prevent you from losing everything in a crash. It's more important to keep what you've got than to earn more. And number five, and lastly, let's lower our expectations. Time to face the truth, folks. You aren't going to get rich overnight in the market. Any strategy with short-term rewards, with high short-term rewards, also come with high short-term risk. I can only tell you how to invest to maximize your chances of long-term financial success and long-term financial security. Nobody, I mean nobody, can tell you how to reliably generate large returns in short terms or in the short term. If somebody tells you they can, I guarantee you they're a con artist. Richard Reyes, Financial QB, Investor Coach. Build wealth, ignore Wall Street, get on with your life.